Hey guys, welcome to the Credit Shuffle Show, and as part of our series reviewing personal finance and investing books, today we're going to be looking at Unshakable by Tony Robbins. Now, this is a cool book, but it has a few things I don't like about it. Let's first talk about the cool things. So basically, a lot of the stuff in this book can actually be found out in the book The Intelligent Investor by Benjamin Graham. But that's a very thick book, and it was written like almost 100 years ago and updated over time. So it's a little bit hard going to read. This is actually written last year, and you can see it's not that thick. It's got quite large print, and it's got a few like charts and stuff in it that helps you understand stuff. So I'd say it is definitely a book worth reading for the sort of investor who wants to kind of like set it and wait and leave it alone. A sort of hands-off approach to investing. So let's look at some of the key points from the book, which I think are very interesting. First of all, Robbins starts off talking about how financial advisors in the US do not actually have to recommend products that benefit the people they're advising, which is pretty shocking. But legally, they don't have an obligation to do that, so they often recommend products that they're getting a commission for selling and have high fees, like 2-3%. Bleeding money basically from your investments. He talks about the only type of financial advisor that is legally forced to recommend things that benefit the client is something called a fiduciary, which, where do they come up with these strange words? Anyway, but the complicated thing is fiduciaries can also be regular financial advisors, and you don't know what they're acting as when you employ them. So the whole thing is a huge gray area, very strange, very complicated, and basically the conclusion that I came from it is just don't use a financial advisor. So Robbins goes on to recommend just using straight ETFs and index funds that are ETF index funds, which have fees certainly lower than 1%, maybe 0.5% or even less per year, and will let your wealth grow much faster. And he talks about a lot of this book actually is about dispelling your fear. Is about sort of your emotional side, not to freak out if you see the value of your stocks go down, just to buy and hold and have the balls to just keep holding. He also talks about the importance, or actually lack of importance, of market timing. So if you buy stocks in a recession and watch them go up, you can have some fantastic gains in the short term, like 2 or 3 years or in a 5-year period. But over 30 years, if you bought the stocks 30 years ago, no matter whether you bought them at that time, at the bottom of a recession or when the market was at a peak 30 years ago, by now, the person who bought them, when the market was low 30 years ago, will only have a little bit more money than the person who bought them when the market was high 30 years ago. And that's what this book is about. It's about long-term investing, basically saving for retirement. And a lot of it's about minimizing fees, minimizing your tax burden, so tax-efficient accounts, in order to get the most out of a sort of buy and hold portfolio. And he does have some recommendations. He's writing it with Peter Mallouk, who goes into sort of the more technical side, more practical side of it, does recommend some different types of investments for you to invest in and some to avoid. So he recommends ETFs, MLPs, Master Limited Partnerships, REITs, real estate investment trusts, as good investment vehicles for steady long-term gains. He advises against investing in gold, which is something which I don't really necessarily agree with, because I do, I have seen the massive increase in the price of gold when we went into 2008 recession, and gold certainly does act as a great insurance for when the market goes down. You can then sell your gold, use the cash to buy more shares. Another thing in the book that he points out, which I think is really great, is the importance of starting early. He gives some great examples of a person who saved $28,000 by the time he was around 30, didn't save any more, and retired with like 1.8 million or something like that. And so starting early can really make your money grow very, very fast towards the end of your saving. If you started when you're 20, and in your late 40s, mid 50s, your money is going to be growing like, wow, exponentially. There's also some things that I don't like so much about this book, and the main one is that he's constantly trying to upsell you. So he has several shout outs for his friend's investment firm, who, to be fair, they do look like they offer a reasonable deal, but I just don't like the fact that he's kind of urging you to invest your money with his friend's firm when, you know, you pay for the book. I mean, this book cost... Oh, there's no price on it. Well, anyway, you know, it costs like $7.99 or $10 or something. So I feel like I've paid for the book. It shouldn't have an advertisement in it. You know what I mean? Come on, Tony. Anyway, I do like Tony Robbins. I think he's a cool guy, but I also think with these things, you know, you sometimes have to take these things with a pinch of salt. He sometimes makes things look better than they are. So yeah, it's a good book. I would recommend if you're interested in long-term buy and hold without much maintenance. I would recommend you read it, but if you're more interested in really getting down into like actually picking individual stocks and trading and stuff, this book probably isn't really for you. He doesn't talk about how to pick stocks. He just talks about, you know, just basically just advises to invest in indexes, index funds, ETFs, and that's it. So guys, have you read this book? Do you think it's good? Leave your comments below. We'll be looking at The Intelligent Investor next time, which is the be-all and end-all stock market investing book, so do tune in for that. As always, please subscribe if you're new, give this video a like, and I'll see you next time. Bye.